Well, good afternoon, financial professionals. I'm Dan Peterson, President and Managing Partner here at E4 Insurance Services, welcoming you to the Brew, building relationships every week. Thanks for tuning in today. And for those of you joining the Brew for the very first time, welcome. As our tradition, we like to start the Brewcast by celebrating today's National Day. Now, obviously, today is Valentine's Day, so make sure you check the one you love and take her out for dinner or take him out. Uh, Give a card, say hello, tell them how much you love them. I remember Valentine's Day as a child, and it was always nice to get those Valentines from the other girls in class. So another day, a national day, is National Organ Donor Day. And I'm not sure how many of you are aware, but our son Jordan, when he was 10 years old, received a double lung transplant. It'll be 11 years in June since that day, his gift of life. And so today is a national day to remember the gifts that people give. Make sure you're an organ donor. You fill that out on your driver's license. You can't take your organs with you when you go. And there's so many people that can be blessed by them. It's also National Cream-Filled Chocolate Day. Seems like that would be appropriate for Valentine's. National Ferris Wheel Day. And it's also the beginning of Lent, Ash Wednesday. Well, hey, today on The Brew, I'm joined by Chad Flanagan. And Chad is a partner with Eide Bailly. He serves on their board of directors, and he's also the Fargo market leader. Eide Bailly is a top 20 accounting firm in the United States, and Chad has been with them for over 25 years. He specializes in performing business valuation services for estate and gift tax purposes. He worked with litigation and purchasing and selling businesses. He performs succession planning to help clients determine future ownership, leadership, and management. And Chad performs financial projections and forecasts, as well as strategic planning for a variety of clients. To share his expertise, Chad has presented for the Prairie Family Business Association, the Red River Estate Planning Council, and various other organizations. When working with Chad, clients can expect an advisor that will help them through the various stages of their business. Not only does he play an integral part in the early stages to understand value and proper capitalization, but Chad stands by businesses as they mature. By being a part of all stages of business development, he increases value and develops strategies for growth and risk management. When he's not working, Chad utilizes his business and accounting background to help nonprofit organizations such as churches, schools, and I've seen him around the hockey rink quite a bit, hockey organizations. I've personally known Chad for probably 12 years and seen his growth as he has grown through the organization and led the valuation area for Eide Bailly. We encourage you to use the chat box or raise a hand to ask questions. Also, attendees are in a drawing for a CE voucher and a Starbucks gift card that will be announcing a winner at the end. Thanks for tuning in. Chad, thanks for joining us today.
Yeah, thanks for having me, Dan. Excited to be here.
Well, we're excited to have you here and to learn a little bit more. We wanted the focus today to have you share with us. You've been in business valuation, and last month we really focused on it. All really begins with the valuation. You have to know the number, and you've specialized in that. But then once you know the number, there's depending on the type of business, there's things called a buy-sell agreement that determines how that business would be distributed. And you've seen the good, the bad, and maybe the ugly over your career. Maybe share with us what business valuation, buy-sell agreements, how do you approach that subject?
Yeah, Dan, I'm glad you're talking about it today. I think it's very important and it's not talked about enough. I have had the opportunity to be at Eide Bailly 25 years, and probably about 20 of those years I've worked in our valuation group, and we do a lot of business valuations for M&A, for tax planning, and for litigation. And all too often, I get involved with buy-sell agreements in a litigation context after business partners aren't getting along anymore, that there's a conflict and there's a dissolution of the partnership to where one of the partners is going to leave. So it invokes the buy-sell agreement. Now, a lot of our clients will pull that buy-sell agreement out of the drawer, dust it off, and think, boy, I hope this says what I think it says, and then start to read through the valuation mechanics, the triggering events, those kind of things. And so I much prefer to work with clients in the planning stage of this. And there are some common problems with buy-sell agreements. A lot of times the valuation mechanism isn't understood. People fight about whether minority interest discounts should apply, what should be the valuation date, how should we be paid. And so only human nature to kind of get that done at the beginning, work with a really good attorney. I need to say that we are not attorneys. We do not draw these agreements up, but we do consult and help make sure that all these considerations are thought through and agreed to, so people really understand what's in their agreement, because that will greatly drive what that potential exit might look like for one of the shareholders.
And with businesses, sometimes what's I've seen, even with working with some of the Eide Bailly clients, sometimes a business starts an LLC, has an agreement, and all of a sudden they start putting assets into this, and the valuation methodology may not match up to the new reality of what's been placed as assets and contributed to a company. How do you handle that, and what do you recommend as far as the timing of reviewing your buy sell, going through that just to make sure you're still on the same page?
Dan, it's a good question for a few reasons. I think every good buy-sell agreement has to have three things in it. One, everybody's got to understand the triggering events. So is it death, divorce, disability, dissolution? All these things need to be thought through. And a lot of times buy-sell agreements will cover all those various different activities. And they may all have the same valuation mechanism, or they may not. But first of all, make sure you understand when the buy-sell agreement is triggered. Secondly, and this speaks to your question, Dan, what is the valuation mechanics within this agreement? Because how a business starts can look very different than some future event, some future triggering event down the road. There's three common valuation mechanics in a buy-sell agreement. One is the easiest. It's a stipulated value. So the owners agree that our business is worth $1 million or $2 million. And we all know valuation is a part art, part science. If the owners agree, there's less chance of dispute during a triggering event. However, we observe that a lot of times a valuation may be set and then years go by before it's set again. Then a triggering event happens and it was never agreed to annually as intended. So pros and cons with stipulated value. A second is formula clause. And again, this can be very easy to apply, simple. Some industries might trade at 5 times EBITDA. Some might be 1 times revenue. These kind of easy metrics to apply to your business and agree to a value. However, to your point, Dan, working capital could be wildly different. There might be unused assets. There might be land or other fixed assets in the business that aren't accounted for using that formula. So we oftentimes see that this can be a difficult thing to do, to capture all of those things in one simple formula. I often think too, sometimes I've seen book value used in a very, very profitable business that has significant goodwill. It's obviously not captured in book value. So some pitfalls with that approach too. The third one, and this is going to be a little self-serving, is appraisal. That you actually hire a firm to appraise the business upon a triggering event or every few years, so everybody understands the value of the business and what's driving the value of the business. An appraiser can consider excess assets. An appraiser can consider growth trajectory, unusual risks, rates of return, all of those things. And so naturally, I would recommend that, but if done right, all three could be a good approach. It just needs to be revisited annually at a minimum, and make sure all of your partners know how it works. And then
You
Dan,
said that, I
the
think,
third item that
yeah,
is in every good buy-sell agreement is a funding mechanism. Especially when you consider death being a potential triggering event, and you want partners to buy out the estate, and how do they do that without putting the health of the business in jeopardy? Is there a life insurance solution for that? Just something to take care of all parties involved in that unfortunate situation.
recently we've been growing our disability income side, and I know that Brady Serold, our DI, Senior Vice President of Disability Income, he's a underwriter by background, but he always says, well, what's the disability trigger? And who decides what that is? And that's also language that's in there. And then, as you just said, the funding, where's the money going to come from to fulfill that? And that's really the role that a lot of our advisors can play with us, is bringing solutions to the table that can provide that liquidity that's going to be needed so that the business isn't hampered. Uh, Sometimes, though, Chad, you may have two or three business owners, and one of them may not be insurable. And so we may not be able to get to the liquidity of all of the owners. How do you structure a buy-sell language, and and the if you can't fund it, what are some other options other than insurance?
Yeah, one certainly is to put a payment structure in to pay out the estate or pay out other shareholders over time. That's a simple one. You can put an interest rate in there or something, just again to make sure that you're not sucking all the working capital out of the business upon one of these triggering events. Insurance is a good one, but if that's not available to you, the other thing I can think of other companies using is just maybe sometimes planning for an event, holding cash in the business as opposed to distributing out to shareholders, kind of a rainy day fund for these type of things. But as you know, Dan, these businesses that are growing, very successful, their growth is a huge consumer of working capital, and so you get to be in a situation where you have lots of inventory or accounts receivable really eating up any of the cash flow that you have. And that's it's a tough spot for a growing business to have one of these triggering events and be able to buy out a large shareholder in a worst case scenario.
When it's done right, what do you see in buy-sell agreements? Uh, what's a smooth buy-sell triggering event? How do you see that work? And then maybe we can flip that and say, what have you seen in your career that didn't work and that really left a mess that we should avoid?
Yeah, when they work well, they are usually understood and agreed to by various business partners. The thing I see most often with litigation is maybe different interpretation or some issues that just weren't discussed. And so when I've seen it well, Dan, I've seen where they do make this a part of their annual meetings or the shareholder meetings where they are talking through valuation issues, liquidity issues, potential triggering events, making sure all parties are aware, especially as they bring in new shareholders and have exiting shareholders leave. It kind of provides for some history, some precedent for this. A good team, a good attorney, good tax person, good professionals such as yourself and those on the call to talk through some of these issues, make sure they understand how everything works before a triggering event or dispute occurs. And then on the flip
Annual
side,
meeting.
Dan, the ugly,
Yeah.
yeah, the number one thing I see argued about is associated with valuation, and it's if there is a minority interest. Assume there's three business partners. Do we value the business and divide by three, or do we consider that minority shareholder doesn't have control, doesn't have marketability, liquidity, and apply 20-30% discounts to it? Obviously, the exiting shareholder would be a fan of the former, not the latter. And it's something I see argued about quite a bit, and usually not in the buy-sell agreement.
That's similar to the discounting methodology that on the wealth planning side, I know the CPAs that work in that at Eide Bailly, obviously helping reduce estate taxes and other things. We use minority discounts. You're saying that if it's not discussed or it's not considered as part of the buy-sell plan, that same concept can come back to create challenges, litigation, misunderstandings when it is applied, because the majority shareholder doesn't want to pay out
Yeah,
when there's minority interests. And you've actually
exactly,
seen that.
Dan.
Yeah.
Yeah, it's not to get too technical, but sometimes the word fair market value means discounts should be considered where fair value means it shouldn't. But as people are writing and reading these agreements, they're not necessarily thinking in that manner. And you're right, Dan. It's the same discounts we consider in tax planning. The IRS says that we should use a fair market value standard of value, and that if you consider that if I'm a 10% shareholder, I really don't have a market to sell my shares to. Maybe there's a put that would obviously affect the discounts, or I don't have control when to make distributions, what the strategic vision of the company is, those types of things. And we observe in the marketplace when you don't have control and you don't have marketability, shares trade at less than pro rata share of the company, and so we apply those that same concept to closely held and family business shares.
How would the language look if um, let's just take an organization that has two 47% owners, one 6% owner. Um, you describe the buy-sell agreement as you're going to do a valuation, or the
Yeah.
last valuation that was done. And so you go out, you get your valuation, you determine what that value of the business is. How do you make sure that it doesn't get into a litigious situation where fair market value is being interpreted in that situation?
Yeah, I've seen agreements that do a really nice job to spell it out, and it's just very specifically talked about in the valuation language in a buy-sell agreement. And so it will say, we will conduct an appraisal at fair market value. Here's the definition of fair market value: hypothetical willing buyer, willing seller, those type of things. And it might even go on to say, and we'll consider discounts for lack of control and lack of marketability. Very clear, very well spelled out. All the key stakeholders should understand that. On the flip side, I've seen some that say fair value will not consider discounts and will be the company's value divided by the percentage ownership, or times the ownership percentage. So it really is just being that specifically blunt about that issue and trying to spell it out with the attorney in the language.
We jump back to the disability side. A lot of times we see agreements where it's defined as 12 months or of total disability. Any best practices of how that is defined from your viewpoint?
Yeah, it's a good question, Dan, and honestly, one I don't see a lot of language or definition. I can see where that is a point of contention and argument as much as the valuation mechanics is what qualifies. How do we determine this? When do things kick in? And you probably could share as much as I could a best practice to be more specific on that language and provide
It
more
just
clarity.
a lot of times it comes down, if you and I are partners and you think I'm not pulling my weight because I'm disabled, but I don't feel I'm totally disabled.
Mhm.
Sometimes having that independent third party, which is, maybe an insurance company definition, and whether you qualify for benefits can be a benefit in there
Yeah.
of fulfilling that buy sell agreement, and it takes it out of the emotional of um, two partners that, obviously one is probably not pulling their weight if they're struggling with some sort of health issue that's created this. So
Yeah, I think that's a mentality in reviewing these buy-sell agreements is where might we find confusion, lack of clarity, or disagreement, and yeah, disability would be ripe with potential disagreement, and so any clarity on that should be spelled out.
Divorce is very common in our society, and I see buy-sell agreements with sometimes the trigger. If we go back to your three things that everyone has, the triggering event may be something like a divorce.
Yeah.
What are best practices that you've seen in your career?
Yeah, and the reason for that is just you want to control who your shareholders and partners are, who you're going to do business with. And so, with death, with an estate, with divorce, with the out spouse, you want to control who you're doing business with. And so creating some kind of a liquidity trigger event is important in that case. And so, yeah, we've seen too many buy-sell agreements, Dan, where it wasn't mentioned. Death was mentioned, divorce wasn't, disability wasn't, those types of things. And so if you have it in there, it can be the same type of liquidity or exit as death or other things, but it should be spelled out there. And that's a way to call back the shares into the company, either as treasury stock or to issue out to other shareholders. But you're really just trying to control who are the shareholders and who am I working with.
Do you have, as a CPA by background, a valuation expert? We talked about funding. Do you have a preference whether that is a cross purchase or entity purchased if they're buying insurance to fund the agreement? What are some considerations as a CPA that you look at there?
Yeah, and I'm going to be honest. I know that decision is a complex one with tax considerations and just mechanics of how it would work. And so I don't want to talk out of school too much. I think what's just important from the buy sell side is that you are able to pull those shares back without creating liquidity problems for the business itself. And so whatever way you can most efficiently do that and minimize taxes is certainly the best way to go.
Well, avoiding a liquidity crisis within that's really a primary objective that you counsel on as
Yeah.
you're working with your company's clients. Well, that's good stuff there. One of the challenges I think that I've heard you talk about in the past that is if you don't have proper valuation, the IRS may say that it wasn't that it was a gift, or there could be other consequences. What are some of the things that the IRS may come to you that you've seen?
Yeah, Dan, that's a good question because do the two tie together? Do I get to do whatever I want in a buy-sell agreement, and then when I do some tax planning, go through a more formal fair market value valuation? I think when you have family relationships, there is a scrutiny put on the value used in the buy-sell agreement. And for example, there's court cases out there where, was this a disguised dividend? Was this a disguised distribution? Where was the transaction conducted at arm's length, or was there a sweetheart deal given here to minimize on tax? So that scrutiny can come up, especially when you're dealing with family members. And so again, if you maybe one of the cleanest ways is to have fair market value by an appraiser spelled out in your buy sell agreement. That's the same approach that's going to be taken on the tax planning side. The two will correlate and should be well supported and stand up to scrutiny. I understand that's not always the case and not always a problem either. If the argument is if it's a non-family member, they have the ability to negotiate some of these terms. They have all agreed to it, and therefore, doesn't that represent the market? So it is a great question you bring up, Dan, a complex one. But there's always this kind of look to how does this compare to what the IRS might deem as fair market value, and does that create a problem if it's too different?
Nelson asked a question in the chat. in the chat, Chad. He asked, can a provision for valuation be used to freeze the value for estate tax purposes?
So the great question. It's the estate tax freeze is a very, I don't know if it's common, but often used in estate planning. And not our assignment is always, hey, will you value these shares as of this date? So we do sometimes see some of the estate tax freeze planning techniques, but our task is always just tell me the date, and the assignment is appraise the value as of that date. And so I don't know the pros and cons of the estate freezing techniques as well as I should, but I'm sure you've asked because you've seen that, and like you said, I think especially for very quickly appreciating assets, that's always the trick with the estate planning is let's find those really accelerated appreciating assets and get those moved quickly. And I know an estate freeze might be part of that technique, but as far as getting into the pros and cons of that, I can't speak as well to that.
So there are times where gifting is being done that we're going to freeze, and the valuation then can be done at that point, and then growth of that asset, appreciation of the asset after the gift can freeze that value. But as far as a buy sell, it depending on the trigger we're talking about, a death trigger, for example, you're really valuing it as of the date of death for estate tax purposes, correct?
That's right, Dan, and you're right. I mean, a gift is the best way to freeze the value, get it into generation 2 or generation 3's hand, let the appreciation grow that way. And so that's the simplest freeze kind of technique. But you're right, on a buy sell upon death, it's almost always a date of death valuation exercise. And one question that comes up often is, should those life insurance proceeds, if that was the funding mechanism, be included in the valuation or not? Are we looking at it 1 second before death or 1 second after? And there's court cases out there too, where it's kind of a facts and circumstances deal. And but don't forget to think about that as you think about date of death trigger for the buy-sell agreement.
Right, right. Yeah, and they get step up in basis issues as well sometimes with the structures there. So that's a good consideration to take into consideration. Well, if we have any more, we'll open it up for any additional questions, either in the chat or a lot of people are on mute, but if anybody wants to ask a question, I think it's a good to recap. You said, Chad, that every good buy-sell agreement really has 3 areas. You mentioned the triggering events that are very well described and that everyone is on the same page for, the valuation mechanics of whether that's stipulated formula, book value, appraisal value, having that really spelled out and agreed to in advance of what that means as far as fair market value and language around that, because that can mean different things, and you don't want to get into that for litigation purposes. And then a funding mechanism, where's the money going to come from? And so that focus on, you said you focus a lot on capital and making sure that you're not stripping the organization of all of its working capital so that it can be an ongoing concern. We do have another question that did pop up. How long does your average valuation, you do formal valuations. A lot of times insurance companies will offer an informal valuation, which is just really looking at the tax returns, balance sheet, profit and loss statements, and come up with an informal based on 5 different accounting methodologies. But you do formal valuations at Eide Bailly. How long do those typically take?
Yeah, good question. This is going to be important too, right? We're seeing an uptick in demand for some gift and estate planning with some of the sunsetting of the coming up in January 1, 2026 of the estate tax exemption. And so a lot of people really accelerating some of their planning to move some shares, take advantage of that larger estate tax exemption. So typically, a turnaround for a business valuation opinion would be 6 weeks or so. And that process really is we ask for a bunch of information, we work through it, look at market comps, industry benchmarks, perform all the same due diligence we think a buyer should do in an actual transaction. We meet with management, interview them, put it all together in a report for those stakeholders to review, understand, and then final it in about a 6 week time. And again, these opinions they can be a 70, 80 page report. We do them most often with expectation of IRS scrutiny in the courtroom, or just a large deal where people want to make sure the proper due diligence has been done. We do also offer value calculations where valuations are done for planning purposes, but you need a more sophisticated look at the various different methodologies. And so we do sometimes do something kind of in between the one you talked about, Dan, in the formal, but expect a month to 2 months of a turnaround time for those.
So that's the first piece of even, obviously one of the triggers of death, getting a valuation 1 to 2 months of time within that 9-month window before the estate tax return has to be filed. So
Yeah, you've got that window, and you can sometimes get extensions and those kind of things. But yeah, lining up an appraiser is always, especially in the next couple of years, I think might be more difficult than one might think.
we're already seeing that with estate planning attorneys saying, don't wait till
Yeah,
and expect us to be able to move on this. So you get in early and make sure you have that.
yeah.
Chad, thank you. That taking a half hour here on our brewcast this week. I'd like to remind everyone that today's recording will be posted on our brew blog and emailed to advisors later today. And Chad, we have a giveaway, some CE voucher and Starbucks gift card, and we'd like you to pick a number between 1 and 34.
I gotta go 32.
32. Who's the winner? Stacy Kupski. She's the winner of the CE voucher and a Starbucks gift card. So be looking for that coming your way from all of us here at E4 Insurance Services. Uh, Chad, thank you for joining us. On next week's brew, Brady Serold, our Senior Vice President of Disability Income, and I will be conducting our focused planning series and February's case study focused on buy-sell agreements, and we'll be looking at a real-life business, a manufacturing business that we had the privilege of helping with the funding arrangements, Chad, and it was also a business that had your firm do, and we'll keep it anonymous, of course, but your firm did the valuation. So we'll be
Great.
looking at that case study next week, a real life case study, and look forward to going over that with everyone. Thanks, everyone. Make it a great day. Happy Valentine's Day. Chad, thank you again. And we'll see you all next week on The Brew.